starting where most about investing, big Australian companies. These are companies make or produce that stuff you use every day. So this is Coles and Woolies where we do our shopping, Transurban, the roads we drive to work on, Qantas, the airline we fly on, Boral, make the bricks, the houses we live in. So these are the things that touch our lives every day. And they are those big brand names that you would buy large capitalization, which means large value companies. So these companies are worth $1 billion or more, perhaps. And when we talk about Australian large capitalization shares, generally talk about the ASX 200, the 200 largest on the Australian Stock Exchange, or the ASX 300, which is the 300 largest. And over time, since records have been kept, since about 1900, the Australian Stock Exchange has returned average annual return about 13%, which makes it the highest performing developed market since that time. That's not necessarily true more recently, but historic case. And of course, that return goes up and down. So if you'd invested $100 on the 1st of January 1900, you would have, and did nothing else other than reinvest your dividends, you would have made an actual return of 10%. So be very careful about looking at arithmetic averages on returns. So the question arises, how do we invest in these large companies in Australia? And there are 4 main ETFs, ETFs, an exchange traded fund. So it's a very convenient way of buying all 200 or all 300 in a single trade. It's generally very low cost. 0.04% is as good as zero. So the 4 big ones are Baker Shares Australian 200 ETF or A200, the BlackRock iShares Core ASX 200, IOZ, Vanguard Australian Share Fund, which is an ASX 300 fund, and the Spider SP ASX 200. Now, these are all very close. The slight outlier here is the Baker Shares product, and that tracks a slightly different index. Part of that is to avoid paying S&P a license fee for the index, but it does do a reasonably good job at managing the ins and outs. So one of the biggest problems with an index is you have to deal with companies that were in the top 200 yesterday and the price has fallen, so they've moved out of that 200. When do you take them out of your basket? You obviously don't want to be doing that every day as they pop back in again. They move from 199 to 201. So the methodology where you add companies or take them out around that margin does make quite a big difference. And that's mostly where the difference between these indexes lie. So there's some subtle difference in how they deal with companies where they're big single shareholders. And there's some subtle differences in how they deal with companies with overseas listings. But to all intents and purposes, they are thus. And you can see that in the return graph here, which shows that if you go back to June of 2018, which is the earliest there's data for all of these, they are indistinguishable. And over 6 years, got a difference in return of 1-2% between the highest and the lowest. So that begs the question about how do you choose which one to buy? Although they return significantly, substantially the same over time, there are significant differences within the month. So this graph shows the spread between the highest performing and the lowest of those funds. And you can see that there are some quite substantial differences in the month. It all washes out over time. And much of this is around cut-off times and closing dates. minor regards. So if you're trading these things, you need to be aware of these. If you're holding them long term, this is largely academic. But one thing to note that in that period, there were 23 negative months on the market as a whole. And of course, they all moved in broadly the same. There's nowhere where one's positive. So that's really the line. So that's just what do we prefer? We use the Vanguard Australian Share Fund Power Portfolios, largely because it's the biggest. It's got 27 billion under management, which creates a slightly big liquidity. IOZ, as a result of being the top 200, it has outperformed as marginally. Now, that's not what you would expect. Small cap shares should largely outperform large cap shares. But in reality, that 200 is such a big portion of that 300. That's not really material in an Australian context. Can you go wrong with any of these? Probably not. We like VAS largely because of its size and liquidity. Hence, its spread is low. Yep, there's much bigger differences when you start looking at other asset classes. So VAS is out. That's very much here. But the important point is that fees are all indistinct. There is no practical difference between 0.04% and 0.06%. The timing of your trade makes a bigger difference. So I wouldn't get too excited. So that's the Australian market. And for most Australian investors, that will form a very important part of, and there are a bunch of reasons for that. One, of course, that you're earning and spending your money in Australian dollars. That tax treatment is good. It's familiar. You don't have to worry about currency risk. So for all those reasons, Australian shares should be bedrock of the growth portion of your